What if I told you that the money you're carefully saving right now could be silently destroying your wealth? Not through bad investments. Not through scams. But through the very act of saving itself. Most people grow up hearing the same advice: save your money, be responsible, build a nest egg. And on the surface? That sounds perfectly logical. But history tells a very different story. In every major economic crisis, the Great Depression, the 1970s stagflation, the 2008 collapse, the post-COVID inflation surge, there was always one group of people who did everything right, and still ended up poorer. They were the savers. Today, we're going to look at why saving money, during a crisis, can actually accelerate your financial decline, and what the smart money does instead. Here's something most people don't realize: money sitting in a savings account isn't just sitting still. It's moving backwards. Inflation is always eating at your cash. When the official inflation rate is 8%, and your savings account pays 0.5% interest, you're not earning money, you're losing 7.5% of your purchasing power every single year. It's like putting water in a leaky bucket and calling yourself prepared for a drought. The number in your account stays the same. But what that number can buy shrinks, month after month. That's not safety. That's a slow bleed. Let's go back to the 1970s. Oil shocks. Rising unemployment. Inflation hitting double digits in the United States. The people who played it safe, who kept their savings in cash or low-yield accounts, watched their net worth collapse in real terms. A family who saved $10,000 in 1970 found that by 1980, that same amount could only buy what $5,600 could a decade earlier. Meanwhile, people who held real assets, property, commodities, inflation-linked investments, came out ahead. History shows a pattern: cash is a terrible shield in an inflationary crisis. And here's the terrifying part: most crises are inflationary. Now here's where it gets counterintuitive. During the Great Depression, prices actually fell. Deflation. Which sounds great for savers, right? Wrong. Yes, the dollar got stronger. But wages collapsed, banks failed overnight, and millions of families who thought their savings were protected woke up one morning and found their bank had simply closed. Gone. Between 1929 and 1933, over 9,000 American banks failed. There was no FDIC insurance yet. If your savings were in one of those banks, you lost everything. What people needed wasn't more savings, it was liquidity, diversity, and tangible assets. The ones who survived best had land, goods, and community, not just dollars. Fast forward to 2008. The financial system nearly imploded. Housing crashed. Lehman Brothers vanished in a weekend. Conventional savers in money market funds suddenly faced something called breaking the buck, the terrifying discovery that even these ultra-safe instruments could lose value. Meanwhile, people who had diversified into gold saw it rise from $700 an ounce to over $1,900 by 2011. Real assets. Hard assets. Things you can hold. The lesson the wealthy already knew, and that most people learned too late, is that in a crisis, cash-heavy portfolios are dangerously exposed. We don't have to look far back for the next example. After COVID-19, governments around the world printed trillions in stimulus. Supply chains shattered. Demand exploded. Between 2021 and 2023, inflation in the US hit 40-year highs. The people who listened to traditional advice, max out your emergency fund, keep 6 months of expenses in cash, watched that cash lose 15 to 20% of its real value in under 2 years. What happens next is surprising. The people who suffered most weren't the reckless ones. They were the responsible ones. The disciplined savers. Because they followed advice designed for a stable economy in a world that had suddenly become anything but stable. There's a deeper layer to this that most financial channels won't tell you about. Saving money feels good. It feels safe. And that feeling of control is one of the biggest traps in personal finance. When a crisis hits, people instinctively hoard cash. It's a survival reflex. But that reflex was built for a world where money held its value, where a gold coin buried in your backyard meant something in 10 years. In a fiat currency world hit by crisis, hoarding cash can be the most dangerous move you make. The emotional comfort of a growing savings balance blinds people to the economic reality happening around them. This is exactly what banks and governments count on. So what should you do instead? Let's be clear, this isn't about not saving. Emergency funds matter. Liquidity matters. But the wealthiest, most crisis-resistant people in history have always followed a different playbook. Diversify across asset classes. Gold and silver hedge against inflation. Real estate holds intrinsic value. Index funds spread your risk. Foreign currencies can insulate from a collapsing domestic currency. Hold less cash, more stores of value. Commodities. I-bonds. Treasury inflation-protected securities. Assets that respond to inflation rather than get crushed by it. Invest in skills and income generation. In every historical crisis, the people who thrived had multiple streams of income, skills, businesses, trades. Savings get eroded. Skills compound. Think like the wealthy. The ultra-rich don't sit on cash. They keep just enough liquidity and deploy everything else into assets that either keep pace with inflation or beat it.